Investment flash.
Markets are near all-time highs, and today's signals are screaming macro stress. Buddy, what are we missing?
Good morning and welcome to Investment Flash, London edition. It's July 7th. I'm Marie, joined by Tom and Gerald.
Morning. And Tom, you're right. The tape is oddly serene. Let's get into it.
BlackRock has a China call. Avoid broad ETFs like KWEB. It's down 28% this year. And pick individual winners like Alibaba.
Alibaba at 10.8 times forward earnings? That's dirt cheap for AI exposure, even with China risk. I'm in.
Yeah, look, cheap for a reason. Beijing just forced Baidu and Tencent to strip AI personas out of their chatbots. That's not a tech-friendly backdrop.
Gerald, that's exactly my point. The regulatory whiplash is structural. Stock-specific bets in China are like threading a needle during an earthquake.
Right, but if you get the needle right, the payoff is massive. Alibaba is a distillation of that. Pure AI optionality at a value price.
Fair enough. But Nikkei also says Q2 GDP slows to 4.6%. The macro headwind is the real risk for anything China.
And FXI near a 52-week low tells you the market knows. KWEB is down 28%. Picking winners in that tape requires a lot of local knowledge.
All right. I get the bear case, but 10 times earnings, buddy? I can't ignore it.
Moving to auto tariffs, WSJ opinion piece says USMCA renewal uncertainty is already freezing investment. Ford and GM are structurally exposed.
GM at 5.5 forward PE, Ford at 7.6. These already discount headwinds. But if the pact falters, margin hit is binary.
Yeah, and the stocks have been dead money. I'd rather own something with a catalyst, like the bank payments play.
Wait, JP Morgan and Bank of America leading a consortium to build a bank-owned card network? That's seismic.
It's about time. Visa trades at 24 times. MasterCard at 23 times. Those multiples are built on an interchange fee moat that's under attack.
Exactly. JPM at 14 times, BofA at 11.7. If they capture even a slice of those fees, it's a huge re-rate.
Hold on. Who says the banks can pull this off? Tech infrastructure, merchant acceptance, consumer habit, Visa's network advantage is decades deep.
Marie, the balance sheets are there, and JPM alone processes trillions in payments. They have the scale to make it work over time.
Totally. I'd buy JP Morgan and Bank of America here. In short, Visa and MasterCard. The risk-reward is skewed.
All right. I need to see a working product before I bet against a duopoly that's been bulletproof for decades. But I'll watch.
Now, the Japan trade. Yen weakness and rising JGB yields. WSJ calls it a global volatility risk.
EWJ is up 17% year-to-date, within 2% of a 52-week high. If the BOJ blinks, that thing can crock.
And VIX at 15.5? No one's hedging this. The dollar-yen above 150 with yields rising is a pressure cooker.
To be fair, the BOJ has kicked the can for years. Another yield curve control twist could smooth it over, but the setup is dangerous.
I'd buy dollar-yen on further strength, but also own VIX calls as a hedge. If yen/JGB sparks a volatility event, you want convexity.
And short EWJ. It's the most overbought index on a cross-current of rising yields and a weak currency. Gerald, your bond doom loop returns.
Fair enough. But honestly, the Japan story is underappreciated. The market is sleeping on it.
Switching to something completely different, the K-shaped economy in one stock, EzCorp, up 75% this year.
Pawn shop chains servicing both low-income quick cash and affluent luxury resale. It's a dark but brilliant business model.
16.5 forward PE after that rally. Still reasonable. The risk is a recession forcing even the high-end client into loans. That's the model.
Exactly. It's a recession-resilient play with luxury optionality. I'd buy it here.
And now, the most original take of the day. CoinDesk on Vitalik Buterin's plan for Ethereum's biggest rebuild since the merge.
Quantum resistance and privacy features. That's a serious technical leap. Ether up 12% in a week.
This is a narrative that can carry for years. The supply-demand story strengthens. I'd buy Ether here.
But execution risk is massive, and competitive threats don't stand still. Years away means a lot can change.
Fair point. Still, it's the most ambitious tech upgrade in crypto right now. Deserves attention.
All right, let's not forget the UK media deal. Comcast Sky buying ITV for £1.6 billion.
Comcast at 6.2 times forward PE is absurdly cheap. This deal gives them 21 million British households, scale against the streaming giants.
Regulatory scrutiny is the question. UK may look at media consolidation, but I'd lean buy Comcast on the valuation.
ITV shareholders get a premium to the 9.2 times forward PE. It's a win-win for value hunters.
Now, oil. Bloomberg says OPEC Plus agreed to hike output into a surplus threat. USO down 2.5% this past week.
Wait, yesterday I was bullish on energy, and today XLE is down another 0.8%. Timing, buddy.
This is the problem. Fundamentals are loosening, while XLE trades at nearly 20 times trailing. If crude slides below 80, it's a crater.
But MarketWatch says, historically, when oil exits the danger zone above 90, stocks rally. SPY plus 10% year to date.
See, falling energy costs are a margin tailwind. I'd buy the S&P on that, but the 27 times trailing PE makes me nervous.
Exactly. If oil's decline is demand destruction, not supply relief, the rally thesis falls apart.
I'd sell USO and XLE. The short side in energy is strengthening.
But wait, Eni at 8.6 times forward is investing in lithium. Energy transition plays are the green option here.
The lithium ETF is up 15% this year. Eni's move validates the sector, but I'd be cautious after that run.
Commodity plays have momentum, but the oil glut thesis dominates. Let's talk semiconductors. SK Hynix US listing backed by a former OpenAI researcher's hedge fund.
No way! That signals insatiable demand for high bandwidth memory. SMH up 62% year to date, still 10% below its higher.
3 major tech investors behind the listing. This validates the AI memory thesis. I'd buy SMH here.
All right. Now let's synthesize. Multiple signals today scream macro stress, but the S&P is just 1% off all-time highs. What gives?
For real, Gerald. VIX at 15.5 with a BOJ catalyst, China slowdown, oil surplus. It's priced for perfection.
And the bond market isn't in any of today's headlines. I'm seeing corporate borrowing costs surge, credit spreads widening. The surface is placid, but underneath?
Exactly. That's the contagion channel. A strong dollar and higher yields squeeze emerging markets. Not Japan or China alone, but a dollar liquidity event.
So the trade is owning volatility. VIX at 15.5 is cheap convexity for all these potential catalysts.
Pair it with a short on EWJ, the most overbought index with the worst crosscurrents. That's the thesis. The world is noisy, the S&P is quiet, and someone is wrong.
As always, none of this is investment advice, but that's our synthesis of today's signals.
And we're back later today with the New York edition at 9 a.m. New York time. If you're just finding us, hit follow on Spotify.
Or check investmentflash.com for the full digest with charts and sources. See you in a few hours.